Why the stock of Coca-Cola is trading at $83 while Google stock is trading at $356. Or in other words, is Google much more expensive than Coca-Cola? This is a question that many people that are unfamiliar with the stock market has. If you are supposed to buy when prices are low and sell when they are high, this looks easy. Of course, it's not as easy as that. Think about it like a math problem on how to split a pie. The more pieces you cut, the lower in size each piece will be. It's the same with stocks. The number of shares in the market, sometimes called the free float, determines the initial price. Later, with markets up and down and the company running its operations, prices change. But still, after many years of operations and market trading days, we need a way to compare different companies. After all, we want to make a decision about them to allocate our hard-earned money. Here is where the ratios come in. Ratios are a way to relate different numbers about a business. They help us see if the price that the stock is trading at is high or low in relation to how well the business is going. There are many ratios to look at, but the three main ones are the price to earnings per share, the enterprise value EBITDA, and the price to book value. The price to earnings per share, or PE, is the most common one. Used to do simple and quick comparison, it relates the price of the shares to the earnings per share. The earnings per share is just a number obtained by dividing the total earnings in their last year by the total number of shares outstanding. Then dividing the current price by this number gives you the PE. So now you have the PE. How do you know what is high and what is low? It is true that different businesses carry different PE due to their nature, but historically, the S&P 500 index has determined a PE number of 15 as the average. Below 15, the company is theoretically cheap, and above it, it is theoretically expensive. So you want to buy companies with a low PE in general. Now there are some important caveats to this. A low PE can signal a declining business or big problems in the company, while a high PE may signal super fast growth. Many tech companies have PE ratios in the 20s due to yearly growth of their business also in the 20s. In that case, the high PE is absolutely justified. The PE ratio is just a starting point to compare businesses, but does not substitute checking the rest of the numbers. Now coming back to our original example, what is the PE ratio of Coca-Cola and Google? Well, at the time of this video, both companies have a PE ratio of 26. So in theory, both companies are equally priced. But in reality, if Google is growing much faster than Coca-Cola, you are buying it cheaper. I would say in this case that Coca-Cola is expensive and Google is fairly priced. Enterprise value EBITDA is another ratio. It comes out of dividing the total value of the company, including cash and debt, between their earnings before interest, taxes, depreciation, and amortization. That's what EBITDA stands for. This number is preferred to the PE sometimes, as it takes into account the cash and the debt the companies carry. As with PE, the lower it is, the cheaper you are buying. Finally, price to book value refers to how much the price of the stock relates to the value of the assets of the company. The book value refers to the price assigned to everything the company owns minus debts. Think about offices, factories, trucks, patents, trademarks, intellectual property, and so on. All these assets should be reflected in the books at the price that someone could buy them today. Then, dividing the current price of the stock by that number, you can see how many times you are paying for their assets. If you can find quality companies trading at less than one-time book value, or in other words, trading below what their assets are worth, that can be a good investment. Of course, this is a very simplified analysis to show you how investors think when valuing stocks. I hope this was informative, and see you in the next video.